Okay. So obviously you will not, ne? Obviously you will not um
Mm.
you will not sell that car for 50,000. Why? Why do you think? Why?
Because it
Mm-hmm.
lose value.
Okay, if you buy your, let me say your phone, ne? You guys all know how much you bought your phone for, right? If you decide to sell your phone today, will you sell it at the
Mm.
same amount that you
Yes.
bought it? Will you sell it at the same amount that you bought it?
No.
No. Why do you think? Why will you not sell it? If you
No.
bought it for 5,000, why will you not sell it for 5,000? Hmm?
It lost its value. Lose its
Exactly.
value.
It lost its value. Meaning that
It's
when as for as long as you are
mm.
using the thing, for as long as you are using the phone, it's losing value. It won't be brand new as it was. Ne?
Mm.
Sometimes it can even break down, like some parts will be
Mhm.
missing, the camera will be broken. Obviously, it's losing value. And assets lose value when they are being used.
Mhm.
That's why if you buy a car for 50,000
Mm.
this year, after 5 years, you can even end up selling it for 20,000. So the difference, ne? You bought it for 50,000 and you sold it for
Mm.
20,000. So the 30,000 is the depreciation, the losing in value. So in other words,
Depreciation.
depreciation is the losing in value of assets. When your assets lose value, they are depreciating. You understand? So because now,
Mhm.
because our financial statements are presented or are prepared according, if you remember, Foibe, in the previous session we spoke of the prudency concept, né? The prudency concept says that we should make sure that
Mhm.
our assets are not overstated. And we do this by calculating depreciation.
Mhm.
You need to make sure that you cannot be recording 50,000 because you bought your car for 50,000. You cannot be recording 50,000 each and every year in your balance sheet. No, because if you are to sell that car, you won't sell it for 50,000. You understand? You always need to subtract the losing
Mhm.
in value,
Yes.
meaning each and every year, your asset will lose value. Do you understand? Each and every year, your asset will lose value. And therefore, for as long as you are using it, it will lose value. And therefore, you have to account for depreciation each and every year at the end of the year. Okay, so depreciation. So in this case, depreciation, we have different methods, but we have the two main methods. So the first
Mm.
one, depreciation. So the first one is straight line method. Straight line method, the formula of straight line method is cost multiplied by percentage given. So it's cost price, you multiply it with the percentage given. Or there are two formulas,
Mhm.
or if you are given number of years, ne? If you are given number of years,
Mm.
now instead of getting your
Mm.
percentage, you are told that no, the asset has a useful life of 10 years. Then it will be cost,
Mm.
the formula is cost divided by number of useful life years. Meaning that if you buy a car today, then you make a what? Then you make a provision that, oh, I think my car, this car will only last for 10 years. So the formula will be cost divided by number of useful life years. That is your cost. That is your straight line method.
Yes.
And then you have reducing reducing balance method, or in other words is known as diminishing balance method. Diminishing balance method. So with diminishing balance method, the formula is cost minus accumulated depreciation, and then you multiply with percentage given. Now, what do I mean by accumulated depreciation? Accumulated depreciation is depreciations for the previous years. The depreciation that you calculated in the previous years, those are what you call your accumulated depreciation. And it's always given in your trial balance. It is always given. You don't need to calculate it. It is always given. So those are the main two methods, or those are the only methods that we use. You understand? When you are drawing up our financial statements. Ne? So you should know these methods, you should know the formulas, because there is no way you'll get an income statement and there is no depreciation. It's just not possible. Especially especially in the examination. There's no way you'll get an income statement that has fixed assets but has no depreciation. Okay. So
Okay.
So can we any questions before we move on? Any
No.
questions? Okay.
No question.
So everything is clear?
No.
Okay. Now,
Yes.
what are we told about depreciation? What are we told about depreciation? We are told that depreciation on vehicles should be provided at 20% per annum on the reducing balance method. Ne? And then a new vehicle was purchased.
Tell you.
And a new vehicle was purchased on the 1st of September 2011 for 60,000. Okay. Now, in this case, you are told that depreciation. Another thing that that you need to know about depreciation is, we said that depreciation is calculated each and every year at the end of the year, right? But depreciation, something you should know is that depreciation is calculated starting from the month, in a pro rata base, meaning that starting from the day, or starting from the month that vehicle or that fixed asset has come into the business or it has been acquired. That's when you start depreciating your asset. Meaning that, let me say our financial year starts in January and ends in December. Ne? So in April, you bought a new vehicle. So when you are going to calculate depreciation at the end of the year, at the end of the first year, you need to calculate depreciation starting from the month you bought the vehicle in April. So there is no way you will include January, February, March because the vehicle was not in the business. How can you calculate depreciation for something that is not in the business? So the vehicle came into the business in April. So you need to calculate depreciation starting from April, meaning you need to find out how many months. So it's April, May, June, July, August, September, October, November, December, meaning it's 9 months. The vehicle only stayed in the business for 9 months. The vehicle only stayed in the business for 9 months in the first year.
9 months.
So obviously you will need to calculate depreciation for 9 months. So your answer, it will be multiplied by 3 over 12. I'm sorry, 9 over 12 months. Do you understand? Okay. Now you are told that in this transaction, you are told
Yes.
depreciation on vehicle should be provided for 20% at per annum on the reducing balance method. And you're also told that a new vehicle was purchased on 1st September 2011 for 60,000. You understand? So in this case, you are told that the vehicles at cost were 130,000. And then a new vehicle was bought for 60,000. Do you understand? So in this case, you will need
Where did you get the 130? Oh.
the vehicles at cost price. If you check in your balances that you are given, vehicles at cost
Okay.
price is 130,000. So you need to calculate depreciation for the vehicles that have been
Yes.
in for the vehicles, a full year depreciation for the vehicles that have been in the business.
130,000.
Yes, in the trial balances.
Yes.
In the balances. So you need to
Oh,
calculate two
okay.
depreciations, ne?
Uh,
The first one, depreciation for vehicles, a full
okay.
year depreciation for vehicles that have been in the business for the whole year. And another depreciation for the vehicle that was bought during the year, that was bought in the middle of the year. Do you understand?
Okay.
Okay. Now, what you need to do first, you need to find out the total amount of the value of the vehicles that were not, that were not bought in the current financial year. So it's 130,000. You have to subtract the vehicle amount that was bought during the year. You understand? Okay. Remember these balances you were given. The balance that you were given of 130 also includes the vehicle that was bought during the year of 60,000. Now you need to subtract it because you need to calculate depreciation separately because of the months. You need to calculate its depreciation separately because of the months. So how much will it give us? Nine is it 90,000?
70,000.
70,000.
70. Yes.
So it will give us 70,000, eh? So 70,000 is the total amount that 70,000 is the total amount of vehicles that have been in the business for the whole year. And so a full year depreciation needs to be calculated. And you are told the depreciation of using reducing balance method is cost less accumulated depreciation. So it will be 70,000 70,000. And then you subtract your accumulated depreciation. So what is our accumulated depreciation?
13,000.
Minus 13,000. How much will you get?
57,000.
You get 50?
57,000.
You get 57,000.
7.
And so you
7,000.
multiply your answer with 20%. You are told that the percentage is 20. So you multiply your answer by 20%. And how much will you get? 57,000 times 20%. 0.20.
11,400.
11,400. Now that is the depreciation of the vehicles that stayed in the business the whole year. Now let's calculate depreciation of the vehicle bought during the year. So the vehicle that was bought during the year is the one that cost 60,000. Ne? Do we understand, or am I a bit fast?
Now we understand.
Okay. So the vehicle that was bought during the year is 60,000. And so we need to calculate depreciation according to the months. So how will you know how many months it has stayed in the business? The first thing that you need to find out is the beginning of your current financial period and the end of your financial you need to find out your financial period. When does your financial period start and when does it end? Now you're told that it ends on the 31st of March, ne? So if your financial year ends on the 31st of March, when does it start? If it ends on the 31st of March, when does it start? Who can tell me? The next day, because the next day will be another financial year. Today we are on the
1st of April.
1st of April, meaning that your financial year starts on the 1st of April. It starts on the 1st of April. So this financial year started on the 1st of April 2011, and then it ended on the 31st of March 2012. You understand? So that is our financial period. Now you are told that the vehicle was bought on the 1st of September. Now you need to calculate the number of months starting from the 1st of October to the 31st of March. So it's September, October, November, December, January, February, March. So how many months?
7.
Only 7.
Starting from when? 1st of October.
Starting from the 1st of September. Starting from September. It was bought on the 1st of September. So you need to start depreciating from September. So it's 7 months. So it stayed in the business for 7 months. Okay. Now because this vehicle is new, it was never depreciated in the past. So your accumulated depreciation on this vehicle is 0. It is new. It was not depreciated in the previous year because it was not in the business. So it's new. So in this case, your accumulated depreciation is 0. Do we understand? Do you understand? Remember,
Now repeat that again, Shavina.
Maybe you can repeat it.
okay, we said you are told that vehicles are calculated using your reducing balance method. And the formula of reducing balance method is cost
Yes.
less accumulated depreciation. And we say that accumulated depreciation is the depreciation calculated in the previous years. Now, in this case, the vehicle that was bought this year, the vehicle that was bought this year has no accumulated depreciation, because last year it was not in the business, so we did not calculate depreciation for it. Do you understand? So accumulated depreciation is zero. It is our first time calculating depreciation. Do you understand? It has no accumulated depreciation.
Oh,
Yes.
yeah.
Yes. So that's why it's minus zero.
Okay.
And then you multiply it with the percentage given, which is 0.2. You are told that is zero. You use 0.20%, and again you multiply with the number of months. So we said it's 7 months divided by 12. 7 months over 12. So this vehicle was only used for 7 months when it was bought. So how much will be our depreciation?
7,000.
So we get 7,000. So 60,000 multiplied by 20,000, 20%. Then you multiply it by 7 over 12, you give you 7,000. Will it give you 7,000, right? Sorry, I don't have a
Yes.
calculator with me here. Okay.
Yes.
Yes.
It is 7,000.
Okay. And so let's record our depreciation again. Depreciation on vehicle. Depreciation on vehicle in this case is we got 11,400, and then we add 7,000. So how much will that be? 18,400. And then
Yes.
we have another depreciation on equipment. If you check in at number 7, provide for depreciation on equipment on straight line method, meaning equipment should also be depreciated at straight line method. And we say that straight line method is cost times percentage given. So in this case, depreciation on equipment will be cost times percentage given. So in this case, how much is our cost price of the equipment? What is our total cost price of the equipment?
90,000.
So it's 90,000 times,
90.
and you are told that it's 10% per annum. So 90,000 times 10%, how much will that give us? Is it 900?
9,000.
So it's 9,000. Okay. And so
9,000.
our depreciation on equipment is 9,000. Ne? And then we have interest on loan.
Yes.
Now with our interest on loan, What were we told about interest on loan?
Interest on loan.
We are told that number 3, the long-term loan was obtained on the 1st of September at
Number 3.
mhm, at an interest rate of 14% per annum. No provision in respect of interest has been made, meaning that we acquired this loan in September. We acquired this loan in the during the year, in the middle of the year. So if you acquire today, ne, we are in October, right? You go to the bank and acquire a
Yeah.
loan. Will you pay
Yes.
interest for the whole year? Will you pay interest for the whole year? Since January 2020 until
No.
December? No, you will only pay interest from the month that you acquired. Do you understand? The same as depreciation. So in this case, you are told that you acquired it the same day you bought your vehicle, on the 1st of September. And so you need to start paying interest from the 1st of September. So the first thing, you're told that interest is 14% per annum. So in this case, your loan, what was your total loan amount? 75,000, right? 75,000. You multiply it with 14%, 0.14, and then you multiply it with the number of months. Remember? Because it was acquired during the year. Do we understand?
Yes.
Okay. Please, if you don't understand, just ask. Ne? Feel free to ask if you do not understand. So 70,000 times
Okay.
0.14 times 7/12 will give you how much?
6,125.
6,125. So 6,125 is our total interest on loan for the current year. 6,125.
Okay.
Okay. So another thing, before we add up all our expenses, if you check at oh, I think the only 4 minutes still left. It will end it. Okay. If you check at the second additional information, the provision for doubtful debts should be adjusted to 5% of book debts. What does this mean? This means that if you have your debtors, people that owe you, people that bought on credit from you, sometimes you have no guarantee that they will all pay. Let me say I was one of your debtors, right? And then you realize, and then I just lost my job. I just lost my job. And then you make a provision that Sarafina just lost her job. So I think that she won't be able to pay off my account in full. Maybe she'll only be able to pay 5%. Ne? So that you are making a provision, you are making a guess that you think that you have to write off Sarafina's account of 5% of my account. 5% of your debtors will be written off. That's a provision that you are making. It's not something that will really happen. You are not sure. It might happen or it might not happen. You are just making a provision of what you think according to the situation. You just heard that I'll be going out of the country, or I went out of the country, or I'm just nowhere to be found anymore. Then you'll be like, it has been months without seeing Sarafina. So I feel like there's a high possibility that we won't get our money back. Do you understand? You are making a provision, but that does not mean that it will happen. Because I might come and pay off my account. That's just a provision that you are making. And that's what you call provision for doubtful debts. Ne? And provision for doubtful debts is always calculated on
Okay.
your it's always calculated on your debtors balance. Ne? It's always calculated on your debtors balance. Now, in this case, you are told that our total debtors were how much?
They
How
were
much
2,000.
Okay. Calculation of doubtful debt. Okay. So they were how much? 46.
2,000.
No. Our debtors, 46,000.
46.
We said that we calculate our provision
Yeah.
for doubtful debts on our debtors. So our debtors amounted to 46,000. So we need to calculate our provision that we made. 46,000, and you are told it is 5%. Eh? So it's 0.05. How much will that give you? Oh, and I just realized it's again 40 minutes. So if it ends itself, please just rejoin so we finish this exercise. I don't ask to go without finishing the exercise. Yeah. So if it ends itself, then you can rejoin.
Okay.
Okay. So how much is the amount? What is our
2,300.
2,300. Okay.
Huh?
46,000 times 0.05 times 5%.
2,300.
How much are you getting? 2,300, right? How much are you getting?
Yes.
23,000.
It cannot
Okay.
3,000. It's 5%, not 50%. It's 5